The People's Bank of China is racing to fix a liquidity crisis, one that could topple their entire banking system. What happened, and will their efforts work? Or is this going to spiral into an all-out crisis? Stay tuned. Plus, tonight's show is brought to you by Monetary Metals. If you're interested in earning a yield in gold, paid in gold, check out the links in the pinned comment and description below. Now, let's turn to Bloomberg, where we picked today's story up on the headline. As the PBOC moves to steady the bond market as a downward spiral worries start to grow. And this is everything to do with their financial system, because they're worried that this could turn into a systemic crisis. And the problem here is the PBOC is panicking. They're dumping billions of dollars into their financial system. But the underlying issue here, this is a problem they created, and now is starting to spiral completely out of control. The People's Bank of China put 608 billion yuan, that's 84 billion in US dollars of short-term cash via reverse repurchase agreements, the largest daily net injection since January. So it's very clear, as we've been talking about, that the economy in China is getting worse. But what's going on with the bond market doesn't have anything to do specifically with the economy, has everything to do with the PBOC. They created this liquidity crisis, and now they're trying to stop it from spiraling all out of control. Yields on China's 30-year government bonds slipped after rising for 7 straight days, while futures on similar maturity debt halted the longest streak of decline in over 2 years. So what's happening all of a sudden is rising interest rates are leading to fears of financial instability. This is the same thing we're seeing happen in Japan right now. But what's the underlying issue? Let's go back in time a little bit, because what happened is we saw yields were declining in China. And long-term yields are a sign of growth and inflation expectations, and the bond market was saying, look, everything's moving to the downside. But Beijing stepped in and said, no, we don't want this to happen. We want interest rates to go up. And next thing you know, the market responded. Now they're going up, and the banks are hemorrhaging because they've been buying a ton of bonds, meaning they're dumping them as quickly as possible. And this is creating a liquidity crisis that the PBOC itself started. The recent drop in longer-dated notes has put Chinese authorities on alert for the risk of wider losses as the U.S. trade truce and Beijing's bid to tackle deflation erode demand for debt securities. So what happened here is the banks were buying a ton of bonds. And again, Beijing stepped in and said, look, don't do this. You're going to lose. It's going to be painful because interest rates are going to go higher. Now they've started to go up. But the issue has everything to do with the PBOC and central bank messaging. They're not being very clear here, but they're not the only ones. We see that from the Bank of Japan. We're hearing that from the ECB, even from the Fed. Nobody around the world is certain what central banks are going to do, let alone them. And now that's causing problems because everybody's looking to dump their bonds. And in China, this is creating a liquidity crisis, forcing the PBOC to inject cash. And judging from past experiences, the bond market may see amplified pressure once fund redemptions start. And that's the fear here, is that a string of withdrawals will force fund managers to dump more bonds. And think of it like the stock market. When it starts to go down into a bear market, what happens? More people start selling, and it goes down more, and more people start selling. The same thing's happening here with the long-term bond market in China. There's fears that things are going the wrong direction, and the banks don't want to get stuck with an upside-down bond portfolio. Now think back here in the U.S. This happened. We had a liquidity crisis at the small and mid-sized banking level, and what did we find out? They were seeing a massive unrealized losses, and next thing you know, the whole system nearly ground to a halt. Owning gold is often talked about during times of economic uncertainty. While some choose to hold gold to diversify their assets, there are other options to make your gold potentially more productive. Monetary Metals presents an opportunity to turn your idle gold into a productive, yield-bearing asset with the potential to pay you more ounces of physical gold every month. The income is earned in gold, not dollars, not IOUs, but actual physical gold deposited into the account every month. The approach allows gold owners to potentially generate yield while retaining ownership. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. There are risks to any investment. Risks of leasing gold include but are not limited to loss of gold principal from leasing to Monetary Metals and other counterparties, shipping, or any other time gold is in transit. If you purchase gold through Monetary Metals, you may pay up to 0.75% over spot price. Additionally, the price of gold may experience a substantial loss without assurance of rebounding. This is not a recommendation. Before making any investment decision, it's crucial you conduct through research, understand the terms of participation, and assess potential risk. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. There are signs that the sell-off may be accelerating. Local funds have withdrawn a net 120 billion yuan from bonds in 3 sessions through Thursday. In fact, more than 90% of over 3,000 mutual bond funds that have invested in medium to long-term debt in China have recorded losses from Monday to Wednesday. So what's going to happen is investors start to see interest rates are going up. They're going to dump their bond funds. Of course, that means the bond funds don't have the money to sit on their holdings. They're going to have to sell them, and that means there isn't enough cash in the Chinese banking system to meet the redemptions, and all of a sudden the PBOC's got to step in here, or else they're looking at things spiraling out of control. Again, think of this from the economic perspective. We know their economy is deflating. We know it's slowing down. Rising interest rates aren't going to be the solution. And the pressure has spilled over into China's credit market. The average yield on AAA rated 3-year corporate bonds has climbed 11 basis points so far this week to head for the biggest weekly jump since February. Now think back not too long ago, we saw all these Chinese property developers were facing liquidity issues themselves. And what did Beijing step in and do? It says not to worry, we're going to force the banks to lend money to you. Now all of a sudden the cost of debt is going up, and we know that the property market hasn't turned around here, meaning the cost to get money and service that debt for a lot of these insolvent businesses, it's going higher. Again, Beijing said they wanted higher yields, but as it turns out, well, they really don't. Amid the rotation from bonds to stocks, it makes sense for the PBOC to maintain ample liquidity to contain the risk of a squeeze. And that's the issue here. If everybody starts to believe interest rates are going to go up, they're going to start dumping their bonds. The banks are going to dump theirs as well. And next thing you know, there isn't enough money in the system to absorb all of this selling. And next thing you know, the financial system freezes up, it goes insolvent, and the PBOC is going to have to continue injecting more money into the system. And that's the issue here. We're looking around 84 billion of US dollars in terms, and what are we finding out? It's probably not going to be enough unless there's going to be something that has to change here, and that's messaging from the PBOC that perhaps rates are going to come back down. Investors have been drawn to sovereign notes this year, betting that the central bank will ease policy to support an economy grappling with sluggish demand and property crisis. And yet, what did they hear from Beijing? Nope, that's not going to happen. Rates need to go up. But what happened in actual terms here is banks saw this economy slowing down. They started buying bonds, not just to speculate on the fact that the PBOC was going to cut rates, but because they didn't want to lend into the economy because it was slowing down. Keep in mind, the first thing banks care about when they lend money is getting that back. If they're not going to lend, well, they turn around and they buy bonds. That's exactly what happened here, and now they're selling them. And China's credit growth continued to slow in March, and banks extended fewer loans than expected. So it makes perfect sense of why they were buying bonds. But then what happened? The next quarter came along, and they had new quotas that they had to lend. This was, again, forced by Beijing. Now interest rates are going up, and it's creating a liquidity crisis. The PBOC is maintaining an easy liquidity condition to provide traders with more funds to allocate to bonds that they're now looking to dump to buy stocks. And China's local credit yields have fallen to the lowest level ever as investors snapped up corporate bonds that they're now going to look to dump. And again, this is going to reverberate all across the Chinese economy. It's risking triggering an all-out liquidity crisis. I don't think there's enough money right now to stop it. The question is, as we go into next week, will we see further selling here? Will the PBOC panic even more? I think the odds now are pretty high. But something we're doing to turn the odds into your favor, we are changing the game when it comes to trading. Let's take a look at this recent trade on Momentum Timer Pro. For our subscribers, we told them to buy the ETF ETHE, that's Ethereum, back on July 10th. And what do we see? On the 22nd, they were stopped out for a massive 29.81% gain. But again, we're changing the game. We just built a massive meta strategy. I've got this really cool program I've been developing. It's changing the game. Now, you guys stay tuned to the end of the show, or there's a link in the description below. You'll find that update. Check that out. Because what's happening in China is spreading around the world as Eurozone growth is now stalling as short-lived trade boosts unwind. And what did we hear from the ECB this week? Well, we're not going to cut rates. We don't think we need to cut rates. But again, what do you see in China? Growth slowing down. You see this in Europe. You see it in the US. You see it in Japan. You see it all over the world. And central bankers now going on pause when the bond markets and investors are making it very clear you need to keep cutting rates. European Central Bank President Christine Lagarde also highlighted the economy's resilience after policymakers held interest rates steady for the first time in a year. She acknowledged that front-loading played a role in referring to the trade war. She also cited, quote, increased consumption and increased investment. So what central bankers are saying, look, at all this front-loading of the trade war has led to increased consumption, and we're worried it's going to cause inflation. But what they can't see here is this is just a plateau on one step lower on the ladder. And that's the problem here. Everything is going the wrong direction. And when we turn and look at their flash PMIs, that's a Purchasing Manager Index, well, we can clearly see that the economy isn't turning around. Let's take a look at the Eurozone services PMI. We're seeing this around the world. We're seeing services demand increase, and it jumped to 51.2. That's now a 6-month high. But keep in mind, in the services world, anything under 53 is still a contraction. So we're not seeing a big change here. But let's take a look at the manufacturing numbers. What do we find out? 50.7. That is the output index, now a 4-month low. Remember, output is a major issue here, especially for the labor market. How about the overall manufacturing PMI? It's now printed a 36-month high, which is still just a contraction at 49.8. So we see around the world, manufacturing continue to slow down. And even though we saw a pop in services, could be a summer effect here, we do know where manufacturing goes, services follows. This has everything to do with the fact that manufacturers spend a massive amount of money into the services side of the economy. In July, data pointed to a stabilization of new orders. Again, we're talking a plateau here, thereby ending a 13-month sequence of contraction. Services new business increased for the first time in 6 months, but this was canceled out by a renewed fall in manufacturing new orders. Not really a surprise here. New export orders. Now keep in mind, Germany and the Eurozone export a lot to China, decreased yet again. And of course, this makes sense when we start the show out and we talk about China, how their economy is slowing, how they're having a liquidity crisis. So yes, demand there is clearly going down. This is going to affect Germany's economy and the entire Eurozone. But again, you look at the response from central bankers, they're worried that somehow services are suddenly going to drive inflation. Yeah, I don't think so. The stabilization of new orders encouraged companies in the Eurozone to raise their staffing levels in July, extending the current period of job creation to 5 months. The pace of job creation was marginal and unchanged from June. So there's the issue. Manufacturing, well, it saw a continued decline in employment. Germany and France, however, continue to post the biggest declines in staffing level, and for good reason, because their economies are doing far worse than the rest of the Eurozone. And this is an issue because when we talk about new orders, we talk about the labor market, and let's look at what happens as new orders go down and the unemployment rate goes up. As we move to the global financial crisis, we see the same thing happen again. It even started to in the beginning stages of the pandemic. Remember, the world was headed into a recession then. We didn't see it show up in the labor market. And let's look at where we're at now, because we can see new orders went up, but it didn't lead to hiring. And that is a big risk, because as we see a slowdown here in the U.S., it means hours are going to get cut. Eventually, those jobs that weren't created, well, they're going to go as well. But let's turn to Germany now. Again, we talk about this effect of new orders, a slowdown in demand, and we could see it very clearly with Puma, as their sales are plunging as their new CEO cuts outlook on weak demand and tariffs. Puma cited weaker sales in North America, Europe, and Greater China during the second quarter. Again, validating what we're seeing here is a global slowdown. And this is really important to understand. It's not just China, it's not just Europe, it's the entire world. And they said the trajectory will probably continue through the rest of the year, causing high inventory levels. The company missed estimates on both sales and in profit in the second quarter. Of course, we know what happens when profits go down. It means employers are going to be forced to cut. But the issue here is one of inventories. Remember, we've been seeing inventory building all over the world, particularly having to do with front-running the tariffs. It's going to have a devastating consequence. Let's go back and look at manufacturers' orders of durable goods against now retailers' inventory. Again, we're looking at U.S. data here, and the retailers' inventory is shown on a year-over-year rate of change, and you can see going into the dot-com bubble, inventory levels were rising at an aggressive rate, so much so that consumers couldn't keep pace. Next thing you know, orders go down, we go right into a recession. Let's move forward to the global financial crisis. You see the same thing happen again. Inventories build up, inflation is rising, sales go down, and that means it backfeeds right up to the manufacturing level. We saw the same thing heading into the pandemic, which again, it didn't impact the labor market, but we were close to seeing that happen. And now let's see where we're at. Well, what do we know is that inventory levels were already rising at a very aggressive rate. And then we saw the front running of the tariffs, meaning there's massive inventory builds all across the world. Now, we may not see outright deflation, but the odds of seeing disinflation are extremely high here. And that means we're going to see a lot of people around the world lose their jobs. As we turn deeper here, let's look into Germany. And what do we find out? According to the S&P Global, despite firms growing more upbeat about the outlook, they continue to trim their workforce numbers in July. The scaling back of workforces was consistent with the signs of spare capacity across the private sector. And we've been warning about when you have spare capacity and too many workers, well, you bring your workforce level down to what your capacity is, and that's a problem, as evidenced by further decrease in backlogs of work in July. Now, keep in mind, a lot of these backlogs have been running somewhere around 3 years. The problem is, once those backlogs are up, there isn't enough new orders to keep the entire workforce anywhere in the world, let alone Germany, employed. The risk is they're going to hit the unemployment line. And when you start to look and see what's going on at the ECB, you start to question, why aren't they cutting rates? Because the evidence is very clear that they should be. And that's what exactly the banks and investors in China are saying. You should be cutting rates, but now you're talking them up and you're forcing us to sell because we don't understand where you're going with policy. And we're going to find out next week that the same thing's happening with the Fed, who's probably not going to cut rates, but the economy's saying we probably should be. Let's take a look at the S&P Global here for the U.S. What do we see? Services PMI up at 55.2. That is a solid expansionary number. It's on the low end of expansion, but nevertheless, we now see a 7-month high. How about manufacturing output? Well, it's now down to a 2-month low. Remember that big push to front run the tariffs? Well, it's cooling off, and that means the broad U.S. manufacturing PMI now hit a 7-month low, is back in a contraction, and that, again, is the risk here, because where manufacturing goes, and you see it pushed things up, drove services up, and now what's happening, it's starting to pull back the other direction, and that is a major problem. Again, let's take a look at some further details here from the U.S. data, and what do we see? Alongside upward wage pressures, which is good news for a lot of workers, it means their wages are going to go up. But what is the other problem we've been seeing? Hours worked are getting slashed in a big way. In fact, right now, according to the non-farm payroll report, they're at their second lowest level since the pandemic. Tariffs were also again widely linked to steeper cost inflation, which was increasingly passed through to consumers. And the resulting rate of inflation for prices charged for goods and services was among the largest seen over the past 3 years. Now, this hasn't shown up in the consumer price index because one of the things we've noted, when prices go up, demand is going down. And what I'm wondering, and I continue to wait to see the evidence here, are we going to see inflation expectations surge like consumers think? Or is demand falling at a fast enough rate we're not going to see it pass through? The deteriorating manufacturing picture was also linked to inventory control, as I mentioned earlier, having built up their inventories of both raw materials and finished goods in May and June, often attributed to factories and their customers seeking to front-run tariffs. Manufacturers reported lower stock holdings in both cases in July, meaning they're going to be reducing their capacity and their production, and ultimately, this contraction now in the U.S. manufacturing sector is only likely the beginning. It's likely to get even worse. And now let's turn to Chris Williamson of S&P Global. He says, quote, whether this growth can be sustained is by no means assured. Growth is worryingly uneven and overly reliant on the services economy as manufacturing business conditions deteriorated for the first time this year, the latter linked to a fading boost from tariff front-running, and that is the big risk. That's what we're seeing in China. That's what we're seeing in Europe. That's what we're seeing here in the U.S. is we're starting to see the fade of all this tariff front-running. For China, it's leading to liquidity crisis in the banks, and we could see that spread around the rest of the world, particularly if investors start dumping government bonds. Watch out. You're going to see the central banks panic. The question is, can they plug the liquidity hole fast enough? In China, I'm not so sure. But something we're changing the game on is trading. And I recently built a program, put a bunch of trading strategies into it, built a custom backtesting engine, a real world one that actually says when you get the signal and then when you turn around and make the trade, not these made up ones that people tell you how great their system is. And we're expanding on that, but you can get in on it for free right now. Join either one of my subscriptions. Grab the links to the description below. Use the coupon code for your free 30-day trial because we are launching a meta strategy, and it uses multiple signals right now. It has a Bravo 9, a 200-day moving cross, a golden cross strategy, RSI divergence, a 520 EMA cross, turtle trading, and channel trading. And again, we have optimized this for swing trading. It generates over 130 signals a year and has a 53% success rate, which is far better than any one of those strategies by itself. In fact, most of them, including the ones you love, they're actually far worse than you think, because my custom-made backtesting engine is phenomenal. We're putting more strategies in this. We're going to optimize this, and you can get on this right now. Again, grab those links in the description below. Use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.